the international oil benchmark and Brent Crude, against which Nigerian oil is priced, hit a fresh 7-year high at $93.44 per barrel as of Friday, trading more than $30 high than the federal government's benchmark for the 2022 budget. The 2022 budget, which was signed by President Muhammadu Buhari in December 2021, was based on oil production of 1.8 million barrels per day, with an oil benchmark price of $62 per barrel for a country like Nigeria, which relies on crude oil proceeds for about for about 90% of export earnings. The surge in oil prices means that increased revenue for government, but on the other hand, rising oil prices may also translate to an increased cost of petroleum products, as the country depends heavily on imports due to lack of domestic refining. Over the past month, oil prices have continued to surge as countries relax lockdowns and drop travel restrictions. But Nigeria has not been able to leverage the oil price rally, as its crude oil has remained below quota given to it by Organization of Petroleum Exporting Countries in recent months. Going by this development in the global crude oil markets, the big question now is how will government position itself to take advantage of the surge in increased investment in the oil and gas industry, by extension to the economy. I introduced him earlier. He's joining via Zoom. He's a macroeconomist and fixed income analyst from Chapel Hill, Denham, Mr. Michael Ogunremi. It's good to see you, Mr. Michael, this morning. How are you? Good afternoon. How are you?
Yeah, very well. Thank you, Todolape. Good afternoon.
Yes, Michael, the price of crude seems to be looking very good. Some might even say we could get to $100 per barrel if possible. I don't know. But what do you think is responsible for this in your view?
Well, I think there are a couple of factors driving the bull run we're seeing in crude oil price. But I think the biggest of them will be the geopolitical tensions we're seeing, between, Ukraine and Russia, and then the impact of, other world superpowers, most of which, are oil producers, right? The concern is that, if Russia goes ahead, to invade Ukraine, we might have sanctions coming from Russia. And, Russia, based on estimates out there, supplies about 5%, of world crude oil output. So if you have those sanctions, it definitely means, we might see some sort of, cuts back in the level of oil supplies, and then, rise in the price of oil. So basically, a lot of oil investors are basically, hedging their bets against, in the event of, that event, happening. That's on one hand. On the other hand, you have still a higher level of demand, coming on the back of, industrial activities, popping up. In the US, for instance, a whole lot of supply chain activities, are trying to catch up to the elevated level of demand from households. And so you have quite a pent up level of, demand for crude in that space as well. There's also, the concerns, around, low production coming from the non-OPEC and the OPEC plus, players, While we note that demand, has been rising since the deceleration in the impact of the COVID pandemic, a lot of non-OPEC producers, that's OPEC plus producers, have not been able to keep up. Even within the OPEC space, you have countries like Nigeria still struggling to meet the level of their production quotas. So I think those are the three main factors: the geopolitical tension between Ukraine and Russia, the concerns around, non-OPEC OPEC plus producers have not been able to produce as much as possible, and then the issue with the high level of the post-pandemic demand for crude.
Brilliant submission, as usual, Michael. But I'm looking at the impact on our economy. Our budget is on about, I think, $65. And what impact will this have? But my focus, a country that imports petroleum products. This is not really good news for us.
Well, to be very candid, I think that normally, if you look at historical developments, whenever crude oil prices going up, there used to be a windfall, some sort of boom. Everyone, is aware of the oil boom era we used to have in the 1980s, thereabouts. But what we've seen in recent time is there is a disconnection between rising crude oil prices and the performance of the Nigerian economy. While rising crude oil prices still supports the economy, the truth is the margin of that support has shrunk much significantly in recent times, and I'll tell you why. Currently as we speak, while we can canvass and say that Nigeria is a net exporter of crude oil, the truth is we're a net importer of petroleum products. And when you are in a net import position as far as petroleum products is concerned, it definitely means you're going to be paying heavy on subsidies, and this subsidy is not going to be implied. It's going to be a direct payment, right? And that is exactly, the quagmire that Nigeria finds itself in. So whenever oil prices goes up, the country has to pay enormous level of subsidy to ensure that domestic demand is met. So that's the issue we're currently having. It disconnects, between rising crude oil prices and the performance of the economy, all because we are now a net importer of petroleum products, which means we have to pay more in terms of subsidy.
The price. Okay, I already asked if he could hit $100 per barrel anytime soon. I don't know. Do you think we can continue at this pace and get to that? Before I ask you my next question.
Well, it's a hard call.
Very hard.
But it's a hard call, But my view is that I think there are about maybe three independent factors. I won't say they're independent anyways. I think they're commingled. That really determines how far the price of crude can go. There's a demand, which already I think it has peaked. It's quite elevated right now, but I don't see any significant, growth from the levels we're currently seeing. And so from a demand perspective, I don't think we would have any significant demand that will push oil prices above 100. From a supply perspective, OPEC is gradually raising the quotas of its members, even though some of them are not able to meet up. But the challenge is with the OPEC plus producers, the non-OPEC producers, who are struggling to meet up with supplies. But I think if crude oil is ever going to touch 100, I think it's not going to be because of supply and demand at its surface. It's going to be because there is some sort of external shocks. On top of that would be a geopolitical crisis, right? So if we see some sort of disagreement, some sort of conflict between superpowers in the oil space, I think that's really what can push oil price above 100. But if we don't see that, I honestly don't think it's going to get to that 3 digits level.
All right. I'm also thinking around oil theft, Mr. Guremi. There's been a lot of issues around oil theft, and I'm thinking, what effect would this have on investments? And of course, investors drive oil theft. We see the local refining problems also happening in Rivers State. Talking about the smaller modular refineries and all of the refineries we see everywhere. What effect is oil theft really having on our entire oil and gas industry? What impact?
Tolulope, the truth is this issue about oil theft, is as dated as the history of crude oil exploration in Nigeria is concerned, and it's quite pitiable because it could be avoided, right? The reason, the motivation, behind most oil theft is because the dividends of the crude, of the crude oil, sales and activities, it's not really trickling down to the grassroots. And that is why you see a lot of illegal bunkering, oil theft, pipeline sabotage, and all of that we see, and I think that in terms of what the impact of that would be on the country, I think for me it's a growing informal sector as far as downstream activities, in the oil sector is concerned. Because like I said, now you see a lot of illegal modular refineries, you see a lot of illegal sale of crude oil. And for you to drive investment into a particular sector, it is important that the regulations in that sector is, number one, are suitable for investment, and number two, the impact of the informal part of that sector is minimized, it's reduced to the barest minimum. But as long as, if we continue to have frequent episodes and expansion of activities of oil theft, what it simply means is a bulging informal sector in the oil space. And I think that in a way would sort of clip the level of investment we can see in the country. And I mean, I'll give you a very simple example. If I were a foreign investor coming from from Europe, for instance, and I want to invest in Nigerian oil sector, I will be more afraid, knowing fully well that there are domestic players in Nigeria that can perhaps flood or tamper with my own activities because they are very strong in the informal space. I definitely would have that skepticism bringing in my investment to the country, and that exactly sums up my point.
Great stuff. The refining is what I also like to get your views on. It's a major one, yes. Because if we were refining, at least we wouldn't have all of this challenge of thinking every time when the price of crude hits high like what we have at the moment. And many are talking about this refinery located somewhere in Lagos, around Lekki area. And that's what everyone is talking about now. And even the federal government is committing another 1.5 billion US dollars for the PHRC for rehabilitation. How does all of this come to you as an expert?
We can spend all day discussing Dangote refinery, and the impact it's going to have on the Nigerian economy. But what I'm going to do is I will speak outside of the common narrative, right? The common narrative is, yes, the Dangote refinery is quite instrumental to the growth and development of this country. That is just, I mean, honestly, it is unarguable. It's unarguable because, I mean, if you look at it in terms of FX savings, in terms of domestic supply, I think that yes, Dangote refinery will help. But I mean, you must juggle both sides of the coin, to have a very fair view, of a particular event. So what I think is this: the Dangote refinery is largely going to be, a private player. It's not going to be a public. It's not government owned. Quite right. The government has a stake. I think it's about 20% thereabouts in the refinery, and which I have to give it to the federal government. That was a very wise decision, in that regard. But a large chunk of Dangote refinery is private. It's owned by the private sector. Any private sector player is always in the business of optimizing or maximizing their profits. That is the truth about it. So my concern is when it comes to matters where the refinery has to decide between should we make profit or should we help Nigerians. My concern is I feel they will most likely go for the former option, which is to make profits. And let me give you a bit of example. Let's say, for instance, when the refinery is up and running, and they would prefer to export, maybe to some neighboring African countries to make more money. Would they rather rescind that decision and then sell to, sell in-house, in Nigeria just to meet, let's say, for instance, an escalating level of demand? I think it's going to be a very hard decision to make. And I feel that in that kind of a tight situation, they would rather go for an option that will optimize their profits. That is the only concern I have as far as, the refinery is concerned, And let me also state, that, while it is true that, the refinery is going to save us, some FX and all of that, I think the issue of subsidy is still big, because when Dangote refinery comes on board, it's really going to be a matter of the government will still pay subsidy. Only that in this case is going to be in naira, not in dollars, because if the government wants Dangote to continue to supply Nigerians at this same current price that we're having, then they have to pay for the subsidy. So when you take those two considerations, I think it's safe to say that one should have a fair view as far as the impact of Dangote refinery in Nigeria is concerned.
All right, finally, as we wrap this segment up, I'd like to get your views on the 18 months extension regards to the PIA. I spoke earlier to an Ipman person. I don't know if you've seen pockets of queues at filling stations today. So I asked him questions around supply and distribution of petroleum products. Now, what do you think about this delay? Because the focus is regards to subsidy payments. What do you make of it?
Totally, but the issue of fuel subsidy is both political and
economic.
It's a mix. It's a mix.
It's a real mix. I agree with you.
Honestly speaking, and I dare say that it's going to take a very strong administration that is ready to dare the hordes of Nigerians to take out subsidy, because it's costing us a lot of money. Honestly, it's costing us a lot of money. But what I like to tell, the point I like to canvass most times is, you can't remove subsidy when you don't have functional refineries. That is the truth. And you also cannot remove subsidies, when you don't have some sort of welfare plans to sort of, transmit the savings from the subsidies into. Even if you're not going to use it to, revamp the ailing refineries we have, that fund should in some sort of way go to helping poor Nigerians. And so when you look at what we currently have, it's 18-month extension, the truth is that it's definitely going to result in some sort of fuel crisis. But I don't think it's going to be long-lived. I think it's going to be short-lived. However, in the long term, I think that the more we keep delaying the implementation of the PIA, the more investment losses we continue to have, especially in the downstream sector of the oil and gas sector. And I really think that would be a very huge blow, as far as improving economic growth in Nigeria is concerned.
Well, it's always interesting talking to you. Thank you so much for spending your time with us today, this Monday. Michael Oguremi is a macroeconomist and fixed income analyst at Chapel Hill, Denham. Thank you so much, and do enjoy the rest of your day.
Thank you very much.